you're investing across this portfolio of 200 to 400 separate loans. So a couple of those might be going bad, but it's not going to sink your portfolio at all. Also, your monthly dividends are reinvested into the Flywheel every month automatically unless you opt out for a monthly disbursement back to you. Now, this is another little piece of information from their website. The Flywheel portfolio comprises a portfolio of ground floor real estate loans originated within the last 6 months, carrying interest rates ranging between 9.5 and 14.5%. This investment vehicle offers biannual loan batch updates and has a $100 minimum investment. So for us, the minimum investment for us is $100. Now over here, there's some interesting metrics right now. The rate range, like they already said, 9 to 14.5%. Total invested at this time is $4.3 million has been invested in this. The disbursement cadence is monthly, and currently, if you invest now, you're investing in 267 total loans. And the median loan term right now is 12 months, and the average loan to value is 68%. Now here's something, the fees. The fee that Groundfloor charges to manage this REIT basically is 0.25% quarterly. So it's about obviously about 1% a year is what the fee structure is that's paid to Groundfloor. So this is how it's structured. This is just directly off their webpage, you guys. Under the hood, the Flywheel portfolio is structured as a series of real estate investment trusts. REITs are a specific type of investment fund that pools qualifying real estate investments. Groundfloor acts as a manager of the REITs that constitute the portfolio. We periodically allocate capital across a broad range of the real estate loans that we originate. Overall, the Flywheel portfolio is constructed to deliver an investor experience that simulates investing directly in a broad range of our traditional limited recourse obligation offerings over time. However, whereas investing in these LROs is a manual process, the Flywheel portfolio is automated. Unlike traditional REITs, investors in the Flywheel portfolio are repaid as the loans within the portfolio are repaid, with the option of reinvesting or collecting the proceeds. We expect you will start seeing repayments within 3 months. Now, how is the Flywheel portfolio tax advantaged? I am not a tax professional, you guys. Talk to your accountant about this. Do not take tax advice from a realtor or a real estate broker online, but I will tell you what they say right here. This offering utilizes a REIT structure. Interest dividend income from REITs may be eligible for a 20% deduction under current federal tax laws. This is not tax advice, of course. This tax advantage structure is a feature of legislation that is scheduled to expire on January 1st, 2026, unless Congress renews it. Investors will receive a Form 1099 at tax time, which is simpler to report than the alternative Form K-1 issued by most non-traditional REITs and other funds. So yes, this is a non-traditional REIT. I think what the designation is this is publicly available but not publicly traded, meaning it's not on the stock market or anything like that, but anyone can buy in. Anyone can invest. So accredited investors obviously can buy, but also so can non-accredited investors. That's just basically anyone out there, as long as you're not investing more than the limit is 10% of your basically net worth is kind of the max that you can be investing as a non-accredited investor in these sort of investments. But it's open to basically everyone that's over 18 right now, and that is absolutely fantastic. That's one of the things I love about this is its non-accredited status, meaning it's open for everybody. How are the assets included in the Flywheel portfolio selected? So how do they select the properties that are going to be invested in? The Flywheel portfolio allocates investor capital across substantially all or a representative sample of the first lien loans originated by Groundfloor within the previous 6 months. At the time of allocation, loans must be current and performing and not defaulted. Second payment position loans and Groundfloor notes may be included. So basically, I think you're basically investing in across the board, most of, not all of their properties and all of their second position loans and the Groundfloor notes, which is another thing that you can invest in where it provides a substantially less return on investment